Hey everyone, welcome back to Corporate Decoder. Today we are diving into a report from Aon, and let me tell you, it's less about insurance and more about, let's just say their numbers paint a picture that needs a little decoding. And are they really on top of their game, or are they playing a risky game of chance? We will see soon enough, and if this report gives us a peek into how Aon is doing financially. We'll break down the important numbers, see if they're making more or less money than before, and figure out what's really going on with this big company. This report came out in late April of 2025. This is important because it tells us how Aon was doing at that snapshot in time. It's like a financial weather report for the company. This is an 8K form, which is basically a quick update that companies file when something important happens. It's not as detailed as their quarterly or yearly reports, but it still gives us a heads up on key events. Aon has different types of stocks. One is called Class A ordinary shares, and each share is worth just 1 cent, at least on paper. But the real value is what people are willing to pay for them on the stock market. One also has something called senior notes. Think of these as IOUs. They have to pay these back by 2025 with an interest rate of 3.875%. These are basically loans Aon took out. The report talks about Aon's results of operations, which is just a fancy way of saying how well they did in making money. We'll see if they made a profit or took a loss. There is a press release attached to this report. This is Aon's official statement about how they did. Companies often put a positive spin on things in press releases, so we need to look at the numbers carefully to see the real story. And let's jump into that press release. First, let's look at consolidated results. This is where Aon combines all of its different businesses to give us a big picture view. It's like looking at a family's total income instead of each person's paycheck. This is a key number. Organic revenue growth tells us how much more money Aon is making from its existing businesses, not from buying other companies. A growth of 5% means they are doing something right. Operating margin is the percentage of revenue left over after paying for the costs of running the business. A higher margin is better because it means Aon is making more profit from each dollar they bring in. Net income per share tells us how much profit Aon made for each share of stock. This is what investors really care about because it affects the value of their investment. An increase here is good news for shareholders. Free cash flow is the cash Aon has left over after paying its bills and investing in its business. They can use this money to buy back stock, pay dividends, or make acquisitions. More cash is generally better. Adjusted earnings per share is a tweaked version of the profit per share. Companies often adjust their earnings to exclude one-time events, making them look better. We need to be a little skeptical of these numbers because they don't always tell the whole story. Aon's revenue increased by 6% to $2.1 billion. This means they brought in $114 million more than the same time last year. Is that because the insurance business is better, or are they gaining market share by being more competitive? Who knows? Their net income increased by 14% to $510. This is great news because it shows they are making more profit. This could be from selling more, cutting costs, or both. Hain bought back 1.4 million of its own shares for about 400 million of its. When a company buys back its shares, it reduces the number of shares outstanding, which can increase the value of the remaining shares. It's a way of giving money back to shareholders. Aon is expecting organic revenue growth of around 5-7% for the full year. They also think they will be able to increase their profit margins and have lots of free cash flow. It looks like they are pretty confident about the future tech. Now let's step back and analyze what all these numbers really mean. Aon is a big player in the insurance and consulting world. They help companies manage risks, offer employee benefits, and provide advice on all sorts of business matters. Aon is seeing revenue growth, but it's not super high. A 6% increase is okay, but not spectacular. Their profit is growing faster than their revenue. This means they are getting better at managing their costs, which is a good sign. Aon has been buying back its own shares, which can boost the stock price in the short term. However, it also means they are spending cash that could be used for other things like investing in new businesses. Aon's future looks pretty stable, at least according to their own forecast. However, there are always risks to consider. The insurance industry is changing rapidly, with new technologies and competitors emerging all the time. So where is Aon headed? They are doing reasonably well, they're growing and making money, but they are not blowing anyone away. The biggest opportunity is to use new technologies to improve their services and reach new customers. The biggest risk is that they fall behind the competition and lose market share. The biggest risk is that they fall behind the competition and lose market share. That's all for today's Corporate Decoder. If you found this breakdown helpful, please hit the like button, leave a comment and subscribe for more deep dives into the world of finance. See you next time.